Coming up on Market to Market. The S&P 500 soars to an all-time high while grain futures contracts trade sideways. U.S. oil production surges, but officials say rail tanker cars are endangering the public. And it rains again in California, but it may be too little, too late for some nut producers. Those stories and market analysis with Virgil Robinson and Walt Hackney next.
This is the Friday, February 28 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Despite controversy over its environmental impact, hydraulic fracturing, or fracking, is fueling a renaissance in the U.S. energy sector. If the boom continues as projected, domestic crude production could exceed 8.5 million barrels a day by the end of the year, up 70% from 2008. But getting all of that oil to refineries is challenging, and U.S. railroads are trying to keep up with a tidal wave of oil. Last year, the industry moved 415,000 carloads of crude. That's up more than 4,000% in the past 6 years. This week, though, a member of the National Transportation Safety Board told members of Congress that rail tank cars being used to ship crude oil pose an unacceptable public risk.
Tanker cars known as DOT-111s were involved in derailments in the U.S. and Canada in 2013. The Lac Mégantic crash killed 47 people and destroyed 30 buildings in Quebec, northwest of Maine, across the U.S. border. In North Dakota, a BNSF train derailed just outside of Castleton and created a massive fire that burned for more than 24 hours. Since 1991, the NTSB has been calling for retrofitting or replacing existing tank cars. But it wasn't until 2011 that new cars were targeted for tougher regulations. Those new guidelines are expected to be proposed before the end of the year. But many rail companies complain the process is taking too long and creating uncertainty. Rail giant BNSF refused to wait and has already begun the bidding process for 5,000 new tank cars made to specifications the company has developed. According to NTSB, the DOT-111s are easily ruptured during accidents, releasing crude oil or other fuels like ethanol that then ignites. Also this week, federal regulators issued an emergency order requiring all crude oil shipments to undergo testing to determine how susceptible the cargo is to explosion or fire. This order follows those 2013 rail explosions. The Federal Railroad Administration directive would place crude oil under the two most protective sets of hazardous materials shipping requirements, rather than classifying the load as less dangerous. Federal officials said some of the current cargo is misclassified. Materials could fall under one of 9 categories depending on risk involved. If identified incorrectly, shipments might occur in less protective rail cars, and emergency responders might follow the wrong protocols when responding to a spill.
The first wave of a powerful Pacific storm brought desperately needed rain and snow to Southern California late this week. And urban communities endangered by wildfire just a few weeks ago now face the threat of mudslides. The barren mountain slopes looming above some neighborhoods in Glendora and Azusa were holding after the first bout of rain, but mandatory evacuation orders were issued Thursday for about 1,000 homes. For those farther away from the foothills, the showers offered a brief reprieve from the worst drought in recorded history. But in the Central Valley, an agricultural juggernaut that is home to much of America's fruit and vegetable production, the rain is simply too little, too late for some growers.
With California's agricultural heartland locked in drought, almond producers are letting orchards wither, and in some cases making the tough call to rip their trees out of the ground. Central Valley almond farmer Barry Baker was one of many growers who hired a crew to perform the grim task. Baker removed 20% of his trees before their prime because there's simply not enough water to satisfy his 5,000 acres of almonds.
I just knew that it would be tough to find water for these trees this year, and I'm glad I pulled them out now because it's just impossible to find water.
Baker has tried other options as well. He's dug several wells to pump groundwater, but the quality is poor and there isn't enough. Leaving the orchards unwatered and expecting them to survive the drought isn't an option, he says. Insects infest the dying trees and multiply, spreading to other orchards. Southern California did get a much-needed soaking this week, and residents are preparing for a more powerful storm that could bring heavier rain over the weekend. Rain fell throughout the day Wednesday in San Francisco, and midday showers drenched the Santa Cruz Mountains south of the Bay Area. There are no figures yet to show an exact number of orchards being removed, but the economic stakes and risks facing growers are clear. Almonds and other nuts are among the highest value crops in the Central Valley and the biggest producer of such crops in the nation. In 2012, California's almond crop had an annual value of $5 billion.
Everybody out on the west side will be broke if it continues. There'll be a lot of guys that go broke this year.
The U.S. Bureau of Reclamation announced late last week that it will not be providing Central Valley farmers with any water from the federal system of reservoirs and canals fed by mountain runoff.
Next, the market-to-market report.
Wall Street surged higher this week as the S&P traded at an all-time high, while the tech-heavy Nasdaq hit its highest level in 14 years. Grain markets, on the other hand, were mixed. For the week, May wheat lost 3 cents, while the nearby corn contract moved 5 cents higher. Prospects for reduced production in South America and strong foreign demand were friendly to old crop soybeans again this week, as the May contract gained 53 cents. Nearby meal followed suit with a gain of $17.45 per ton. In the softs, cotton continued its recent decline as the May contract lost more than $1 per hundredweight. In the dairy market, March Class 3 milk gained 35 cents, while the deferred contract dropped by nearly 10 cents per hundred. It was a huge week in livestock, where the April cattle contract gained $3.50, nearby feeders advanced by almost $2, and the April lean hog contract gained a whopping $7.50. In the financials, the euro gained nearly 9 basis points against the dollar. Crude oil advanced by 33 cents per barrel. COMEX gold lost $1 per ounce, and the Goldman Sachs Commodity Index moved fractionally lower to settle at 649.65. Here now to lend us their insight on these and other trends are two of our regular market analysts, Virgil Robinson and Walt Hackney. Gentlemen, welcome back.
Thank you, Mike. Thanks.
It's good to have you both. We've got a great stories going on both on the grain side and on the livestock side, so we're excited to have you both here. Virgil, let's start with you. Let's talk about the wheat market. We've seen the rallies in some of the other commodities. We're not seeing it in wheat. Talk to us about what's happening.
Well, big supplies of wheat globally, Mike, which has been well documented in shows past. However, the situation in the Ukraine is of concern, inasmuch as they originate and move quite a bit of corn, wheat, and other coarse grains. So clearly that's of concern to the marketplace. I think equally as important is the fact the U.S. dollar in the last few weeks versus most currencies, and I'll use the dollar index as our barometer, has come down pretty sharply. And I think that has made some of our product, including agricultural product, more attractive. Weather concerns through parts of the hard red winter wheat belt, as well as other areas of the United States, can't be discounted either. We've got some drought, we've got some adverse winter-type weather sweeping through the middle part of the country again. So I think the combination of those things, Mike, has led to a nice recovery. Trend followers are going to be hopped up here in as much as the trends in a lot of the short-term and intermediate-term indicators have turned up. So I think we've juiced the markets here with a little speculative exuberance as well.
All right, and you mentioned the Ukraine, and that was we saw a lot of headlines coming out of the Ukraine late this week with the airport situation. As we look into the next week, probably in the next couple of weeks, while that situation sorts itself out, does that make wheat an interesting buying opportunity to maybe capture some of that uncertainty as it rolls forward?
You know, at present, Mike, I think it's probably provided a better selling opportunity. I mean, now keep in mind, wheat has been plummeting downward for several months, and the reason, as mentioned, I think, is the global supply. It's not just the Black Sea area. It's Argentina, it's Australia, it's Canada. There is plenty of wheat in the global marketplace. So if I were lugging old crop wheat, I'd be using this type of recovery as an opportunity to move through that inventory and then think seriously about pricing some new crop wheat, or at a minimum creating some type of minimum price.
Get some protection under you in case the market resumes its previous trend.
I would, Mike. I still perceive there to be some downside risk in that commodity.
All right. Well, now you mentioned old crop wheat. As we take a look at the old crop corn market, we did see a little bit of a rally continue this week, up almost a nickel on old crop corn. What was driving us there?
Well, I think demand has surfaced. Again, the Ukrainian situation comes into play. There are some adverse weather concerns and conditions in parts of Brazil where they're trying to take the summer crops off and get busy sowing their winter crop, their second crop. So we have some concerns there, particularly in areas that would traditionally grow some corn. So I think that, in combination with the dollar, in combination with the strength in the soybean markets, has lent good support to corn. Ethanol economics are good. Livestock economics are good. So the demand base for corn is pretty darn solid right here, Mike.
All right. Now, as we look at the new crop situation, USDA at their Ag Outlook seminar last week released some numbers that were probably a little unsettling to a lot of corn producers this year. I think they were saying 370 as probably an average price for 14-15 corn. Looking at those numbers and this little market rally, I mean, does a new crop corn sale maybe make sense up here in this neck of the woods?
I think, again, if your personal crop budget warrants attention here, protecting an equity, perhaps you're growing a few more acres or you're in a rotation of some kind or another. To answer your question, I do think this is an opportunity for someone that's done nothing to this point. Now you have insurance numbers put together as of the end of this month. There are any number of quality decision assisting tools at university ag extension sites. So I think you put the combination of these things together, Mike, and clearly entertain the idea of beginning to protect that new crop price value.
Because the story is coming back, we're probably not going to see, barring a weather event, the opportunities at harvest to sell at the season highs like we have the past 2 years. Time to manage a little bit more aggressively, maybe.
That would be the assumption, and I think the consensus amongst folks tonight. Now, please understand, and Walt and I were talking about this not long ago, the U.S. Drought Monitor continues to be quite concerning, and it appears to me areas of the drought have spread now more through the state of Iowa, parts of Minnesota, parts of Missouri. So it appears at present to be expanding, not contracting. That clearly has to be a concern moving forward as well.
All right.
So crop insurance becomes a pretty valuable tool here.
Certainly. Now, let's take a look to the kind of the sweetheart Cinderella rally of these past 2 weeks, and that's soybeans, particularly old crop soybeans. You mentioned some of the troubles in Brazil. Yeah. Would you like to expand on that a little bit? Is that the core driver on that old crop bean market?
Well, I think it's certainly one. The other is that processing margins have been very attractive, Mike, even as the price of the raw product has gone higher in value. Again, currency probably comes into play. I think there's been some speculative exuberance also surface here. It's kind of interesting inverses, the likes of which we have in the soybean market today. It's been my experience over the last 40-some years, whenever I've seen an inverted market, it ultimately gives way to a carrying charge market, because that strong price signal attracts attention and it attracts an effort to grow the supply. And I think that'll be the case here in the U.S. this season. So please understand, as you get closer and closer to spring and then early summer, carrying an old crop inventory into the breach of what could be a pretty significant new crop here in the United States, there's a lot of risk involved in doing that.
All right. Things to keep an eye on as this year rolls forward. Thank you, Virgil.
You're welcome.
Now, Walt, we're excited we've got you here this week, especially with all of the action we're seeing on the livestock markets. As we look at the fat cattle market, we saw cash trading again up in that 150 area in Iowa and the northern parts. Where is this market going? Have we topped out?
I told a cattle feeder this morning in Hubbard, Iowa, he's in the catbird seat as we speak. But greed is the one area that hasn't been addressed in this entire optimism we've got. And granted, we have $150 in regard to fat cattle prices today. And we probably are going to have that, if not higher, going into this coming week, because availability, as we speak again, is the key to the beef complex. We thought the consumer would not be able to support $1.40 a hundredweight on fat cattle. Today, the packer seems very willing to step in at $1.50. I don't know where the retailers' limitations are, but I do know that $2.40 to $2.42 or $3 dressed in the country versus the $1.50 cash is easily come by here in the Corn Belt. Somewhere in that equation, the consumer is going to opt to spend her spendable beef dollars on a lower quality product than the luxury cuts of the primals in choice beef. That would be select beef. And if you are a student of that market, you have seen that spread between select and choice gradually come together until today. I'm not sure how it closed this day, but it was only about a $2 to $3 differential. Now that is a huge encouragement to a person on a strict budget to buy that more of an economy product. What will that do to choice beef? Where will the lack of attention by the consumer affect the price? As long as we are so limited as we are in the beef complex out of the feedlots, probably it won't have any effect. But you let the packer immediately start buying cattle that are gaining weight instead of losing weight from this extreme weather we've had over the last 2 months. You let those cattle start gaining weight, you let them start complaining of heavier weight cattle, and you watch what the choice beef will do in comparison to the select beef trade or the more economy cuts.
All right, now you mentioned the extreme weather we've been having, and I know you were out in California recently. As we look at the feeder cattle market, what are we seeing there? How are regions coping with this weather?
Well, there's such a differential in the weather per se. The Corn Belt, as Virgil mentioned, Missouri, Iowa, and the like of that, the weather here has been the extreme of the cold and the effect it had on the gainability of these feeder cattle and fat cattle, because they're using up a huge portion of their ration they're eating to maintain their body weight. And in a lot of cases, when you got 0 to 10 below real temperature, these cattle are actually not able to support their intake with a gain. They're losing weight, and they're showing that coming out of the feedlot as finished cattle. The feeder cattle is a different deal. The feeder cattle are purely dependent on the roughage feed supply they've got on hand. Now, the California producer, I happened to be involved with one that had 2,500 head on the high desert out by Bakersfield. He didn't want to sell them all, but he had enough feed left to support the light half of those 2,500 head, and that's what he wanted to sell, was the heavier end, in order to regulate the availability of feed that he had. Mike, hay in California on the high desert is costing $20 to $22 per bale. Now that's not an Iowa bale like you have here in your set. That's an 80-pound bale, and you can't afford to feed cattle with $80 a bale. You can't afford to do it. So the objective is, as he did, he had enough on hand to take care of the light half of his cattle, and that's what he did. I helped him do that.
You bet. Move the rest off to someplace with greener pastures, so to speak.
As far as feeder cattle go, as you mentioned, we're in a severe deficit of feeder cattle. In the fall, we thought we were going into a little better opportunity with winter wheat pasture in the southwest. They had some moisture, enough to produce decent pasture. That went away here about a month ago, and those guys have had to liquidate off of that wheat. You saw it in your placement factor in the cattle on feed report. That was all light cattle. That was all cattle that are to come way down the road, nothing in the immediate, it's all in the deferred contracts. And so as a result, they're going to spread that marketing on those light cattle. And it probably isn't going to have any effect on the inventory because we still are going to be very current on feeder cattle.
All right. Now, as we look at the other protein, the other white meat, as we look at the pork market, that up 7 1/4 this week. Incredible move in the nearby hog contract. Is it all related to the PED virus out there?
I think a large percentage is. We've had a new participant in the PED virus, and that's Canada. That has caused enormous concern in the American opinion of expansion. They're not going to do much expanding in the hog operations until they get some kind of control on the treatment of this PED virus. And the opportunity for it, if it isn't controlled, is for it to take out of our total market hog herd 5% this year. Now that's enormous in terms of hog nomenclature. And it's a huge amount to come out of. That brings it from like 2 1/4, 2.10 million a week. That'll drop you down to around 1.7 million.
And we could see the same effect next year in Canada's hog herd unless we come up with a vaccine or a treatment.
You just nailed it right there.
So as we look to the deferred months this year, as we look into the summer contracts, do you sell in here or do you let this PED continue to put some pressure on these markets?
Where's your level of greed?
That's what it comes down to.
Totally.
This would be a good selling opportunity if you're okay leaving some profit potential on the table.
I had one of my most dearest cattle clients this morning indicate to me that he knows that he could use a basis contract for cattle right now and lock in around $250 a head net profit. But he thinks maybe it's going to $1.60.
That's right. There's greener pastures out there.
Absolutely.
In theory.
Yes.
All right. I bet he's not the first cattle feeder to think that.
I'd say he's of the, particularly of the major group.
All right. We're excited to have you back with us, Walt.
Thank you, Mike.
Thanks for taking the time this week.
It's a great pleasure for your thoughts and prayers, and I appreciate that too.
Thank you much. And Virgil, always wonderful having you with us here tonight.
Thank you, Mike.
That wraps up this edition of Market to Market. But you can find expanded market analysis as well as streaming video of our program free at our website. Now, we want you to remind you that Market to Market may be airing on some different time slots and in some cases even on different channels over the next few weeks due to PBS fundraising activities. We do encourage you to check your local listings for details. And if you value programs like Market to Market, please consider making a pledge and investing in a service that provides you with accurate information and timely market analysis. We do appreciate your support. And until next time, thanks for watching and have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.